Welcome to the Mint Funds and Market Update. I'm Kirsten Boldarin, Amplify Group CEO, and I'm pleased to be joined by Alistair Dring, Assistant Portfolio Manager for the Diversified Funds. If you could just take a minute to note the disclaimer regarding this recording. I'll hand over to Alistair.
Thanks, Kirsten. It's been an interesting time for everyone in the markets, and it's probably worth just touching on how the month of February progressed. A lot has changed since then, but strong relative performance by the New Zealand equities relative to global peers. This is on the back of a robust reporting season and a few significant names posting double-digit returns. Definitely helped push the index higher. Ongoing disruptions in AI and the volatility in tech certainly impacted the US markets. We could see sort of a relative underperformance versus the New Zealand equity names. Interestingly, the corporate bond market in New Zealand had a strong finish to the month of Feb with higher demand versus the supply that was available, pushing those prices up and the credit spreads tightening even further, along with a sort of no decision around a change in the OCR certainly gave New Zealand equities some favorable tailwinds. With all of the volatility that's been going on in markets, it's probably worth just touching on the market impact for that. And what I'd like to highlight here is the considerable rotational trend that we saw from November through mid-Feb, mostly in the materials, energy and consumer staples, and the significant underperformance of tech and consumer discretionary. Now, through 16 Feb to mid-March, those reversions or rotations consolidated. And it's not necessarily that there is a new rotational trend taking place, but more a function of mean reversion, stabilizing of those trades as they looked to have been largely played out, considering that, consumer services, comm services, posted 1.5% return is not necessarily a function of the renewed vigor in that sector, but more of a marginal buyer buying off the low position that sector ended up at. One sector that stood out was energy, and I think understandably so, with the global shocks, geopolitical concerns, and the closure of the Strait of Hormuz, which has about 20% of the global oil and gas supplies moving through that region. Naturally, energy has been an outperformer as a function of a supply shock. So I think it's worth taking a look at how we see the global position and what the potential impacts for that might be. What this slide is showing here is where the global position is around business cycles. And as you can see, the Northern Hemisphere has really been struggling to get their economies into a position of recovery and into expansion, and are sort of sitting at that at-risk or sort of at that late cycle stage. They've been on the journey of cutting their rates, largely have all ended their rate cutting cycle, and are waiting for that stimulus to enter the economies and get them into more positive territory, which is quite noticeably different to the Southern Hemisphere. Taking a look at South America, for example, Australia, New Zealand is notably in a recovery stage. Kirsten will touch on a little bit more about that. But it's important to sort of highlight here is where those flows out of the Gulf region, especially if it's coming through the Strait of Hormuz, most of that travels in its primary capacity through to the east, countries like South Korea, Japan, the eastern borders of China, many of which are large trading partners for New Zealand. A secondary trade flow for particularly LNG moves through to Europe, based on largely because of their sanctions on Russia and the lack of gas flows coming from that region. Now, that shows quite considerably in the yellow zones where a lot of those shocks are going to be most heavily impacted. Because of their position in the cycle, because of that inflationary shock, and because of where they are in their rate cutting cycle, it does lead to some questions around what that means for their sort of GDP growth and the outlook in those regions. There are a few question marks, and it'll be a function of how long and how sustained this exogenous shock to those regions are. With that all said, it's probably worth taking a look at the global exposure to an oil shock or global impact to that. The chart on the left shows over time we're progressing as a global economy to less reliance on oil as an input, but it is still considerable in logistics and the sort of the larger impacts of how goods and services sort of trade and flow around the world. Now, many of the trading partners that New Zealand has sit as net importers of oil and gas, and I suppose energy as a sector. And we can see on the far right-hand side of the second chart, largely those nations that we trade with, especially South Korea and Japan, having a large exposure as a net importer of petroleum and gas. Therefore, will be an importer of that inflationary shock, and there's the potential that that filters through to New Zealand. So there are, again, a few concerns, but again, it's how long and how protracted this shock is for global economies. One thing I would like to touch on as well is there's a second order or an alternative sector in the fact that the fertilizer production as an output from the oil and gas process largely comes from that Gulf region, and for any agrarian linked economies will potentially feel an impact from that in more of a sort of 3 to 6 month lag, as it takes some time for that inflation or lack of fertilizer to impact the growing production capacity, and therefore then impact the price of food. New Zealand as a economy is also linked to those, but one advantage that we have is because we are a large commodity exporter, we have the potential to pass on that inflation cost to those that we supply to, which could be a considerable tailwind, particularly in sort of regional New Zealand. So there are some positives that potentially could come from this in the sort of mid to longer term. The last slide I'd like to touch on is just our exposure to particular nations. We've seen of those nations which are highly exposed to this exogenous shock, but this shows New Zealand's exposure to those particular countries from a trade perspective. Importantly, China, our biggest trading partner, relatively balanced in exports and imports. So two sort of opposing themes there, one being the impact to their economy in terms of growth from the impact to energy prices, but then as a trading partner, are we able to pass on those costs through our exports to that region? So those could be two opposing forces that potentially negate. Something to be aware of and to look out for. With Australia and the US being relatively neutral in their import and export of oil and energy, the impacts from that shock are less likely to have a negative drain on sort of GDP growth. We may be sort of favorable, or New Zealand might have some favorable tailwinds through the commodity price increases that potentially come from foods and more of the agrarian parts of the economy. The other names I'd just like to highlight, South Korea, the UK, and Indonesia, all key trading partners, but all experiencing different impacts from this. All large importers of energy from the affected regions, and that could be a significant tailwind to their GDP growth. And we do export a fair amount, but it's more of a import from New Zealand, therefore potential negative tailwind there. And And then from that, there's not all doom and gloom. There are some green shoots, which I'm sure everyone has heard in abundance from every manager that they've spoken to. But Kirsten will just touch on the New Zealand economy and where we're seeing some favourable growth.
Yeah, thanks, Alistair. In terms of the domestic market outlook, we did get a few releases in February. So unemployment data showed the rate ticked up slightly to 5.4%. So obviously not great that we are actually at the highest level of unemployment in New Zealand since 2015. There was, though, a little bit of a silver lining to that, which is that it came on the back of higher employment, which points to growth in the labour force, which is obviously a positive. In terms of retail spending, we've been tracking this over the last few months. There was a little bit of a slowdown in consumer spending after the bump in November from Black Friday sales, and also business confidence eased back a little bit. This was all pointing to keeping potential interest rate increases by the Reserve Bank of New Zealand in check, with the tone from Governor Bremen's first monetary policy statement sounding quite dovish. Unfortunately, as Alistair has spoken to, we have had a surge in oil prices, which naturally has inflationary consequences. And obviously that then has a knock-on effect in terms of interest rate expectations. So whilst we've kind of pushed out interest rate rises quite a fair bit, ASB is now forecasting that inflation will remain quite stubbornly high at 3% for 2026. And this is likely to mean that where we had previously seen a more dovish stance, that may no longer be the case in terms of where we stand today. And then just moving on to a few more other positives for New Zealand. So tracking net migration. And obviously net migration into the country is positive from a sort of retail sales and housing perspective. So we are starting to see a trend of fewer New Zealanders moving across to Australia, which has obviously been in its ascendancy for quite some time. So we had an annual net loss of 40,000 New Zealand citizens in 2025, which is better than the 43,700 that we lost in 2024. So whilst there are still significant departures, we are at least starting to see net migration, and net migration of non-New Zealand citizens remains positive at about 54,000. So as I said, that should hopefully provide a little bit more support both for the retail sector and the housing market. And I'll let Alistair cover off the two funds.
Thanks, Kirsten. And a positive month for the New Zealand Income Fund, largely a function of our corporate bond holdings. As I mentioned earlier, there was a significant demand for the corporate bond names towards the latter part of February, and with the tightening and improvement in the pricing of those credit names, had a really strong, a contribution to the fixed income component of the portfolio, which is quite considerable for the fixed income fund. Notably, the global equity names that we do hold are in the tech sector, which was impacted negatively, the likes of Accenture, although reporting some strong growth opportunities and some mergers and acquisitions that have taken place. The negatives that had impacted the sector far outweighed those positive sort of reports that they had mentioned, contributing about -7 basis points to the portfolio overall. Positive contributors being FedEx, back onto some strong performance numbers, some re-ratings by analysts that really sort of moved FedEx name considerably, adding 4 basis points. And on a similar theme to the sort of data center and AI play, is now sort of moving into those companies that are providing a data center management services, whether that be power, cooling, automation, and monitoring. The likes of Schneider Electric had a really strong performance and saw some uptick from investors and added about 4 basis points to the portfolio. And then moving on to diversified growth, heavy tailwinds for the New Zealand economy and New Zealand shares on the back of some strong reporting, although that was fighting up against Australian equities and global equities that were quite sluggish, and our global equity names, again, Essentia is a part of the portfolio as one of the tech names struggling, and because of the larger allocation to equities in this portfolio, had a higher negative contribution, unfortunately. But we see the likes of Schneider, again, with a higher allocation, adding some strong performance, but an additional name coming through from pharmaceuticals, GSK, with strong revenue growth, increasing margins, and a pipeline of new drug registrations that have gone through 5 over the year, and highlighting that they've got a robust pipeline of potential new drugs to come to market, and with a good allocation to that, adding 17 basis points. So a better month for the Diversified Income Fund, and again, diversified growth, as many growth allocators will be facing, a few headwinds that are sort of keeping the portfolio somewhere in the negative region. So thanks, that's all from me.
Right, thank you so much for listening. And as always, if you have any questions, please submit them to info@mintasset.co.nz. And we look forward to speaking to you again next month.